Welcome to this video on the head and shoulders pattern. So here we go. This is a part 2. I will put the link to part 1 in the description. And real quick, one thing I just have to say, so I do encourage you to go back and look at part 1, but one of the things that's very important is that we have a move up into a head and shoulders pattern. It is a reversal pattern. So having said that, let's just go ahead and mark our shoulders. Here's our left shoulder. There's our head. And there's our right shoulder. Now, one of the things that makes this a lower probability trade, there's a couple of different patterns within the pattern here. Patterns within the pattern. So we've got our neckline here. And what you don't want is this. Okay, so what do I mean by this? What is this? All right, so we've got our left shoulder, and then you've got the neckline here, the head, and then you don't want this where this comes down below this left neckline. You don't want the right neckline to be below the left neckline. Now, a lot of people mistake this. They don't get it because they think, oh, but I do, because now I've got a lower low and a lower high, and that is a higher probability trade for the market to go down into the future, isn't it? And the answer is no. You would think that. That is the common logic, and common logic in trading doesn't work. Again, once everybody thinks they know something, that's exactly when it stops working. And this whole thing of higher highs and higher lows, it is a fallacy. It is a fallacy. It's outdated, and again, everybody understands that concept, and that's one of the reasons why it stops working. In fact, now that's one of the reasons why large institutions, hedge funds, so forth, even just whales, will catch you on those and take out your stops, because they know everybody's looking for higher highs, higher lows, lower highs, lower lows, and so it's just too obvious. So what happens if we pull this forward? And I'll show you something really interesting here. If we go back and we mark these spots, so you got your left shoulder, your head, your right shoulder. Okay, again, the key is we do not want in between here, between the head and the right shoulder, for there to be a lower low. So once you get that lower low, then that indicates to everybody that now they're thinking, oh, okay, we broke this low, and therefore we have a bearish sentiment in the market. So trading is counterintuitive. Trading these days goes against classic technical analysis, because now pretty much you can just Google classic technical analysis, and once you can Google it and everybody can see it, well, again, stops working. So markets work differently now. So, and some people go short, they'll wait to go short below the low of these lows here, and you'll see again, there you go, that's the exact example I was talking about, where the price will go down there. Sure, it'll go just down below there. That's exactly where a lot of people are getting in, and then it goes back up, and it even takes out these highs over here, even takes out those highs. So yeah, just everything wrong. Everything is wrong about it. You just don't want to trade traditional head and shoulders patterns anymore. So what do you want to do? Okay, let's take a look at that. All right, now let me show you a better head and shoulders pattern, one that works better consistently. I learned this in Chicago from my mentor at the CME, and oh my gosh, has this worked ever since he shared this with me. So I had to pay him a lot of money, but I'm going to give it to you for free today. So the reason this one's better, by the way, first let's just reestablish that head and shoulders pattern is preceded by a trend, because by definition it is a trend reversal pattern. So sure, we got our trend here. All right, so that's good, a long-term move up, and then identify our left shoulder, our head, and our right shoulder. So higher high, lower high. All right, and we're going to go short here. Now, two key distinctions. Number one is my entry will be 1 penny per tick below the low of that bar. Actually, a little harder to see that now, so let me just redraw that for us real quickly. So left shoulder, head, and right shoulder. So that's the bar that I'm going to enter on. My entry is going to be 1 penny per tick below the low of that bar, and my protective stop will be 1 penny per tick above the high of that bar. This is the S&P 500, so in this case it could be 1 penny. All right, now why can I do that? Why can I get in with such precision and risk the range of only 1 bar? And that's because I use my cycle indicator, which I'll be happy to give you for free. I've got a recording that goes through all the indicator, how to set up your charts, and how to trade it. It's about 45 minutes long, I believe. Anyway, here's a link to it. Go there, get it, check it out, and enjoy. My gift to you. Okay, so that's precision. And precision is very important because a lot of traders will wait for these head and shoulder patterns and enter them below that low, or worse yet, below that low. And professional traders, we get in before amateurs. So by the time things are obvious, then it's no longer as good. So what we want to do is we want to get in as early as possible. Now, let's go take this forward a little bit. You can see, yeah, okay, the reward here is huge. So we do get a trend reversal. The direction of the trend reverses. And so our risk reward ratio here, just to kind of point that out real quickly, is our risk again was the range of that bar. And our reward, I'll just draw it right under that, is all of that. So fantastic risk reward ratio. Now, what makes this pattern better than the other one? Very simple. And my mentor at Chicago taught me this. And so we've got, in fact, let me draw that head and shoulders pattern back on here. Because the key is it's 2 patterns in one. It's 2 patterns in one. So sure, we've got our head and shoulders pattern. But the key on this one is that this low here is higher than that low. And that's the key. So you can draw your trend line from that low to that low, and from this high to that high. And look what you got there. You got one of them there triangle patterns, a symmetrical triangle. And so now you have what we call concurrent setups. You have a head and shoulders pattern, and at the same time you have a symmetrical triangle pattern. So there's several different factors that go into play here. Number one is concurrent setups, meaning, again, you got 2 setups in one, therefore a higher probability of success because you got 2 valid trade patterns. Number 2, with the triangle, you've got a contraction of volatility. So we are looking out of contraction to go into an expansion of volatility, and that's where the big reward comes in. Okay, and number 3, again, a lot of people, they don't necessarily look for this. They don't know to trade the triangle within the head and shoulders pattern, and therefore you're getting in earlier than retail traders. And you're doing 2 things. Number 1, you're filtering out the bad head and shoulders patterns, and number 2, you're getting in earlier than the retail traders. So you're improving your win-loss ratio and you're improving your risk-reward ratio at the same time. So there you go. That is the superior head and shoulders pattern. That's the one that I trade. That works out very, very well for me. That gives me the big rewards. Encourage you to pick up that cycle indicator and check it out and combine it. And you can combine, by the way, that cycle indicator you can use with any different chart pattern. I use it with all my entries. In fact, every single entry I take, no matter what the price pattern is I'm trading, double tops, wedges, triangles, just trend continuation trades, I don't take a trade unless I use that cycle indicator because it nails swing highs and lows, gets me in with amazing accuracy and very, very little risk. And well, just giving it to you for free. So go check that out. And oh, by the way, before you leave, make sure you subscribe to the channel. I give, as you can see, real practical trading advice and maybe some things you haven't heard elsewhere. So to be alerted to the next video, I'm trying to do 1 or 2 or maybe even 3 of these a week, trying to increase them. So to get notification of that, subscribe to the Top Dog Trading channel. Do that right now before you forget, and you'll continue to get all this great free trading education on me, my gift to you.